Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 153 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So this week, again, we welcome back our special guest, Nick Whitaker, filling in for Matt this morning. So good morning, Nick.
Good morning.
Good to have you back on. Every other week is beginning to be a common theme here. I think the listeners and viewers love hearing what you have to say, so we're going to keep doing this.
Well, I hope so.
All right, so before we begin, as always, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track, and these numbers are as of the market close on June 8th, and the data is from stockcharts.com and Koifin. S&P 500 index is down 0.4% to start the month of June and down 13.87% for the year. The Dow down 0.24% for the month and down a little more than 9.5% for the year. The NASDAQ Composite Index positive 0.04% for the month and down 23.2% for the year. The IWM ETF that tracks the Russell 2000 index up 1.42% for the month and down 15.69% for the year, which is an interesting development that we'll talk about. The Vanguard International ETF ex-United States down 0.5% for the month and down 11.3% for the year. 3-month T-bill yield at 1.25%, the 2-year Treasury yield at 2.8%, and the 10-year Treasury yield sitting at 3.06%. So the one that caught my eye here, Nick, was small caps outperforming so far to start the month of June, and that's intriguing to me because typically as we start to get near the end of a sell-off or a bear market or a recession, small caps tend to lead coming out of those difficult environments. Now, this is a very short-term outperformance just for the first week or week and a half of June so far, but nonetheless, definitely something to keep an eye on for sure.
Yeah, definitely a risk-on trade when you see small caps and more tech-heavy, growth-heavy names.
Right. So we'll see if that lasts through the month of June. However, those names have struggled in the last day or two. Moving on to big headlines, current events from the week. The first thing was May employment data. So May non-farm payrolls increased by 390,000. The consensus was 325,000. The 3-month average for total non-farm payrolls decreased, though, to 408,000 from 516,000. And one important item to note is that employment in retail trade declined by 61,000 in May, and the number of persons employed part-time for economic reasons increased by 295,000 to 4.3 million. So the latter are employees whose hours are cut due to slack work or business conditions, but to be fair, employment in retail trade is still higher above its February 2020 level by about 160,000. But this is a forward-looking market that doesn't seem to be looking too optimistic for the road ahead in terms of the economy. Another point of contention is how Wall Street interpreted the employment report, and based upon how the market reacted last Friday, it was still too good overall to convince the stock market that the Federal Reserve is going to pause its rate hikes after it increases the target range for the Fed fund rates by 50 basis points at the June and July FOMC meetings. So I think the reaction here was Wall Street wanted to see not so strong job numbers so that they would let the Fed get a little more data to ease their rate of rate hikes.
Exactly.
So it's kind of like good news is bad news at this point.
It's the classic good news is bad news. We see it all the time in the markets where really what the market wants is they want things to remain the same, or they want the projected Fed rate hike to come down a little bit. So
Yeah, they want the monetary environment to be easier.
Yeah, exactly. Good news is bad news here, but the numbers are strong. So the economy is strong.
Mm-hmm. Just falls into the bucket of one of those things that, from an outsider looking in on the industry this doesn't make sense. And
Right, yeah.
Trust me, we have a lot of that in this industry.
Yeah.
So,
Oh, yeah.
I think you have some updates on some items from the SEC and order flow, Nicholas.
Yeah, so I've got, hopefully I can get through this pretty quick, but the other big headline that I wanted to talk through was an article on the Wall Street Journal from the other day, and it was titled, "The SEC's Trading Shakeup Expected to Face Heavy Opposition." So I took a deep dive, somewhat deep dive. I read, a handful of articles, watched a couple of videos just to educate our listeners as to what's going on here. And there's a series of articles on the Wall Street Journal over the past, I'd say, like week, and there was another piece about a month ago about these SEC regulations around trading. And a lot of this was sparked by the meme stock trading frenzy with GameStop, and there was a couple other names.
AMC.
Thank you, AMC. Yep. And the topic of the discussion is called payment for order flow. Okay, so I just want to kind of walk through this for listeners and just kind of explain a lot of these articles and just summarize it for everyone. So what is payment for order flow? When you buy a stock on a platform like Fidelity or TD Ameritrade or Robinhood is one of the highlighted.
One of Matt's favorites.
Yeah, one of the highlighted ones in the articles. That broker will send the order. Often they will send the order to a high frequency trader. The two names you hear a lot are Citadel Securities and Virtue Financial, and they're market makers. Your trade executes almost instantly, right? Because it's algorithms and they execute it. And the way that these market makers, these high frequency market makers, make money is they make money on the bid and the ask spread.
And just to pause there, Nick, for people that don't know, so say, XYZ stock is trading at $20 per share. You're not necessarily going to get $20 per share all the time, right? So there's a bid and an ask, and you buy at the ask and you sell at the bid. Mm-hmm. And typically the midpoint is where the stock is trading, right? Exactly. So for a $20 stock that, maybe the market cap is, $1 billion or a couple $100 million, the bid ask spread could be 19.5 on the bid and 20.5 on the ask. And when you're buying on the ask at 20.5 instead of 20. And that's how these market makers make their money.
Exactly. And it's moving around constantly, right? The market's moving every second, right? And so that's exactly that. Thank you for going into that, and I'm going to need your help as we go through this.
Yeah, and for bigger, more liquid names like an Apple or an Amazon, Facebook, Tesla, Google, the bid ask is a lot tighter,
extremely narrow,
because it's a very liquid name. But for names that aren't traded as much, that could be a lot wider.
Exactly.
And during times of market stress, when liquidity dries up, that bid and ask gets more and more wide. Right.
And so that's how these high frequency traders make their money, is they make a couple pennies on the trade. You've got a buyer, you've got a seller. From Robinhood, it goes to the market maker, being Citadel Securities or Virtue Financial. The high frequency trade occurs, and they take a penny off the trade. Mm-hmm. And that's how they make their money. This entire idea, it allows for almost, the benefits of it allows for almost immediate execution, particularly in like a small retail account. If you go and buy 10 shares of Apple, you bought it, it's executed. And it also has really allowed for zero commission trading, which is pretty massive to the average retail investor. And what I mean by that is, on Robinhood, you can sign up for a profile, you can buy a stock, and you don't have to pay to buy that stock. Back in the 80s and the 70s, you had to pay a commission fee to your broker, basically saying, hey, will you go and purchase this stock and find the best price for me? And they'd call the exchange and call other brokers, and they would find the best price for you, but it would cost you a couple bucks.
Right.
So
and sometimes more than that. I mean, even in the early 2000s, commissions could have been anywhere from $15 to $20 a trade.
Exactly.
So
what is the SEC all up in arms about? The concern is that these high frequency shops and these high frequency money market makers are taking advantage of the spread, which means that the brokers aren't fulfilling their duty of finding the best possible execution price, right? It's the duty of the broker when their client says, hey, I want you to go buy Apple or insert a name, and that's not a recommendation for Apple or any other name we've said here, but hey, go buy this stock. And the broker goes out. It's their job to find the best possible execution price. And the concern from the SEC is that they're not doing that when they're just throwing it to these high frequency market makers, excuse me. And so what the SEC is proposing is that these brokers like Robinhood send their orders direct to stock exchanges to ensure that investors are getting the best possible price. It's worth noting, I noticed that a number of countries don't actually allow payment for order flow, which I thought was interesting. The UK doesn't allow it. And so what do we think about this based on things I've read and what I've looked into? And I want to read an excerpt that stuck with me. And this is a biased excerpt because it's from Charles Schwab, who wants payment for order flow to continue, but I think he makes a couple good points. Charles Schwab, one of the largest retail brokers, has been circulating a policy document estimating current stock market rules allowing brokers to route customer orders to high-frequency traders will save individual investors $120 billion over a decade. I should comment there. I'm going to insert that. That would not shock me if that number was amplified or the math was.
You need a headline grab.
They need a headline grab, but I do think it saves money, investors' money in the long term. I think that's probably accurate. And then he continues to say, we have to be really careful not to destroy the good in search of the perfect. And that was Charles Schwab CEO Walter Bettinger. Adding that individual investors have never enjoyed lower costs and better accessibility. And that part, I think, is true. I think this might be a little bit of that going on where the SEC is trying to get something perfect and it's pretty good. Now, I'm not saying that there couldn't be some corruption or greed going on with these high frequency shops. They make a lot of money. There could be a middle ground here, but I think big picture here, investors have never had easier access to the markets. They're not having to pay massive commission costs. I think that is a win in the system. So it seems kind of like a no-brainer to me from that angle. But I think what will most likely happen, in my opinion, is there's going to be a lot of pushback on this. There already has been. Robinhood's increased their lobby money 20-fold. And most likely what will happen is just more regulation for those high-frequency money market companies, your Virtue Financials, which is not a bad thing. I think that will just help brokers make more informed decisions. That's my guess as to how this plays out. But
Yeah,
I don't know if you have any thoughts about that.
Yeah, I think the important thing to note too is that when Robinhood and Schwab and Fidelity and TD all went to zero commission trading, a lot of people initially thought that it was truly free, and like anything else, that's not the case, right? So you have these big companies that are paying them, like a Citadel paying to get these order flows to execute these so that Citadel can make money, and they know how these people are trading, right? So nothing is ever free, but I agree with you that this zero commission trading has given a lot more people access to the financial markets that previously couldn't afford to do so. So I do think it's a step in the right direction. Most of the times, I do think that the retail investors are usually trading liquid names, that it's not really going to be a big deal and you're not going to see a massive difference. It's not like you're going to get, a 20% cut on what you're trying to buy the stock for. Yeah. It's very, very, very small.
And that's what the articles kind of almost like make it sound like, oh, you're trying to buy a stock at $20 and you get an $18 price. That's not true at all.
Yeah, it's not true. And the other way, it's
1998.
Right. So I think it's, for most people, it's really a non-issue. But it's just, I think, more of the SEC trying to crack down and make things more fair for the smaller investor.
Yeah, and I think a lot of it comes from politics as well, and pressure from the political realm.
I think all the time you're going to have congressmen out there and congresswomen out there saying we have to do more for the smaller investor. You have to do more. Yeah. And it's like, okay, is that just to get in the headlines and to get votes, or is it actually going to benefit the smaller investor?
Yes.
Which, like anything else in the political spectrum, you could have your own opinion on it. But
we'll see.
I have mine.
So that was a little bit of a longer one for the headlines than we normally do, but hopefully that helped listeners.
I think it's important for people to understand how these things get executed, because if you're using a platform and you're doing it yourself, it's just like, okay, I'm going out and I'm buying shares of XYZ company, but I think a lot of people don't understand how the system actually works for you to get that stock in your account. Yeah. So, interesting.
Indeed.
Moving on to tweets, articles, and research from this week. I had one from Ophir Gottlieb. He's a research analyst that I follow, and he tweeted, "Lumber prices are now below $600. It's incredible that prices have dropped 40% in a month, and it's not a story anywhere." That is crazy. We heard all of this stuff about how lumber was going to the sky when commodities started getting more expensive, but literally this is the first thing that I have seen on lumber prices coming down. That's crazy. Yeah, and that's a huge drop.
Yeah.
Right. So that goes to add to why part of the reason, in my opinion, why housing prices are coming in. And I think we're going to see a little bit of a cool down in prices, but that's just wild to me that no one really is talking about this. And maybe it's because other commodities remain elevated, like especially energy.
Yeah. Oil is the headline these days.
Right. Yeah. But this is a, good sign, in my opinion, that something like lumber is starting to come in. And I guess we'll see over the next couple of months if other commodities follow in its footsteps. But just thought it was kind of crazy to me that this is the first time that I've seen this. And really from their high, I think lumber's down over 65% from its high set last year. So not everything is super, super expensive like you may think it is. And I understand lumber isn't used as much by the everyday consumer like oil and gas is, right? I get that. But this is one of the things that I think we should keep an eye on to see if other commodities start to roll over, because, if that is the case, then the Fed may look at this stuff and be like, okay, maybe we're getting closer to our target and where we need to be, and we won't have to raise as quickly. So I think it's a combination of things. You start to get more commodity prices roll over. You start to get positive news out of Russia, Ukraine. Could set up for a pretty violent rip to the upside in the equity markets, in my opinion.
Yeah, it also will help. These are the kind of data points that are kind of the beginning of helping to ease some of that inflation.
Right.
When you have some of the commodity prices coming down, you've got investors pulling, or not investors, consumers pulling back their spending a little bit because gas prices are high. All of that kind of stuff in the economy helps start to bring inflation down. And if inflation can be the word you'll read and the market is sticky, if it's less sticky, that will be a great thing for both the economy and the markets. Right. The Fed won't have to get as aggressive with which Wall Street loves, and inflation will come down, which is great for consumers. So I think it's a good sign in the grand scheme of things. Yeah.
Still a long way to go, but it's good to see that at least some things are beginning to roll over. So.
Yeah, it's a good chart. People should look it up, because what I remember is everyone freaking out about lumber in the summer of 21, and you can see why. But it's interesting to kind of see that was it. I just remember that, and then there wasn't anything on the news when it came back down.
No.
And then it went back up a little bit at the end of 2022. Which is kind of interesting.
It was crazy, and we were doing some construction on our building, and our contractors. We had lumber out in the back parking lot, and I was like, should we be leaving that there overnight, or should we lock that up somewhere? So yeah. Kind of crazy. So we'll keep our eye on commodities to see if other things follow in lumber's footsteps. Next thing I had was a blog post by Ben Carlson on May 3rd titled, "Why Does the Stock Market Go Up Over the Long Term?" And I really like this because I think a lot of people who are just getting involved in investing and getting involved in the equity markets, they don't really understand why this is a way to make money or the mechanics behind it. So this is a really good, simple post that I think everybody should go ahead and read. I'm just going to read a little bit from what Ben wrote, but he started off the article by saying the long-term trend in the stock market has historically been up and to the right. It hasn't gone up in a straight line by any means, but stocks go up most of the time. Since 1928, the U.S. stock market is up 9.8% per year. The market is up roughly 3 out of every 4 years, and there have been no 20-year periods where the U.S. stock market has been down on a nominal basis. But why is this the case? Why does the stock market go up over the long term? I know a lot of people think the Fed controls the stock market or low interest rates, or it's the Illuminati that's pulling the strings. But in reality, the biggest reason the stock market goes up over time is because the economy grows and corporations earn more money. In 1928, earnings per share for the S&P 500 was $1.11, while corporations paid out 78 cents per share in dividends. By the end of 2021, those numbers were $197.87 and $60.40 respectively. This means over the past 94 years, earnings on the U.S. stock market have grown at an annual rate of 6%, while dividends have grown at 5% per year. Being an investor in the stock market means you get to take part in the profits and cash flows of corporations. You get to benefit from their innovation, investment, and growth. Let's look at the biggest stock market as an example, or biggest stock in the market as an example. In its fiscal year ending 2014, Apple had sales totaling more than $182 billion, with a net profit of $39.5 billion. In the fiscal year ending 2021, Apple's revenue was $386 billion, and the company produced net profits of $94.7 billion. Sales more than doubled while the company's profit was up 140%. Meanwhile, in the same time frame, Apple paid out more than $103 billion to shareholders in the form of dividends.
It's incredible.
It's crazy. And Apple is not alone in paying dividends to shareholders. The average payout ratio for the S&P 500 corporation since 1928 is more than 50%. This means companies have paid out more than half of their profits to shareholders in the form of cold hard cash. The market value of the entire U.S. stock market in 1982 was $1.2 trillion. Apple alone is now worth more than $2.5 trillion. The stock market goes up over time because businesses get bigger and earn more money over time. If you own stocks, you earn a piece of that growth. The stock market also goes up over the long term because sometimes it goes down in the short term. And if you think about it, the stock market has to go down. It wouldn't offer such juicy returns if you didn't get your face ripped off every once in a while. $10,000 invested in the U.S. stock market in 1928 would have grown to something like $66 million today. But look at all the carnage that came along the way to get there. And he posted this chart in the article of all the drawdowns in the S&P 500 since 1928. So there were times where, from peak to trough, markets were down 44%, 83%. 20%, 22%, 56%, 50%, 48%. So we have to go through tough times to get where we are today, right? So when you invest in the stock market, like we've talked about here before, you don't simply get 8 to 10% per year, year in and year out. You get some combination of huge gains followed by bone-crushing losses. It has to be this way or the long returns wouldn't exist. If the stock market was an easy thing to do, everyone would be a buy and hold investor. The fact that it's not always easy is one of the biggest reasons the stock market goes up over the long term. What are your thoughts?
I mean, just a ton of great points in there. I like it a lot. Of course, I'm in this industry, so I get it, and it resonates with me on a number of levels. But I think the end, especially where he says, if the stock market was easy, everyone would be a buy and hold investor. And I do believe that fundamentally, I think. And I know Jenna, I've said similar things to you before. where especially when you're young, like get in the market, just get in the market and be consistent with it. And you
just
talk
keep
about
buying.
this and just keep buying, and it'll be okay. Over your lifetime, it's going to be higher. I truly believe that. And I think this is speaking exactly to that. So.
Yeah, I think it was just simplified it for people on, why do people make money in the stock market over the long term, right? So really good post there by Ben. The last thing I have was a tweet by Brandon Van Zee on April 21st. So he tweeted, "Not a great look for the markets right now from a sector rotation perspective." And again, this was more than a month ago. The top 4 rankings on the sector selector that we use at his company, I'm assuming, suggests the possibility of markets being in late expansion to early contraction territory. And we'll have Jenna put this tweet up on the YouTube page, but it kind of shows the sector rotation during different economic cycles, Nick. Mm-hmm. And near the peak is when you start to see energy, consumer non-cyclicals, utilities, and basic materials outperform. And those have been the strongest areas of the market over the past couple of months. So one could think that we have already hit the peak in our economy and we're riding this wave lower. However, the point I want to make is that it doesn't necessarily mean this has to last for a decade, or it has to last for 5 years or even 2 years. It could be 1 year, or it could be 6 more months of this. No one knows, but with this sustained outperformance in energy, utilities, healthcare, materials, I think it does have some merit that we're going into a different market environment. Mm-hmm, and I think it's tough for people because it hasn't happened in so long, and you've been fine holding the aggressive areas of the market, consumer discretionary, financials, technology, communication services, for the longest time, that it feels so different and so weird right now that people have to shift their thinking that, hey, we're just in a completely new market environment than we have been for the past 5 years. So
or longer.
Yeah. So again, if this stuff didn't happen, then investing would be easy and returns would be lower. But like I've said before, sector rotation has to happen in the market. And you see what happens when it doesn't in 1999 to 2001, when technology was a crazy outperformer for 2-3 straight years. Then it came crashing down. So there needs to be sector rotation in areas of the market that outperform and underperform during different market environments. And I believe we're just going into one of those periods that tech may underperform, or aggressive sectors may underperform for a little while. And that's okay. That's normal. This isn't the first time this has happened before.
Exactly. I have a couple points I want to make on that for listeners that I think will help. Are you going to put this chart on here okay, so Jenna's going to put the chart up here, and the first point I want to make is this diagram. This is what they teach you in finance and school. Like, this is a textbook kind of chart of what a cycle, quote unquote, cycle can look like. But the second point I want to make is, and you've already made it, but I just want to emphasize it for listeners, is that the length of these cycles are wildly different throughout history. The expansion, the middle expansion can last for years and years and years, or it can last for a couple years, and has happened at different points in different points in history. And the other point I want to make is that that's part of the Fed's job, is to monitor these cycles and try to make it easier, the pain easier, right? Which is one of the reasons why our recessions in the past couple of recessions have been a little bit quicker relative to like a Great Depression, right? That's all learning. That's all us as a society and the Fed learning from history, learning from these cycles, and the Fed using all the policies that they have, all of the tools in the tool belt to try to ease markets and the economies through these cycles, so to speak. So to your point, I'm 100% in agreement with you that where we are, it could be 1 year, it could be 2 years. it could be longer, right? We don't know exactly how this is going to go, and that's the tough part in the market. But this is kind of your blueprint textbook curve.
Yeah, and I think just the takeaway from this is you have to be, as investors, as portfolio managers, we have to be open to the idea of change, and be able to allocate portfolios according to that. And I know that, people have become extremely attached to their more aggressive stocks that they hold because they've performed so well over the long run, right?
For a decade.
But again, it goes back to this theme, and by no means am I saying that some of the largest companies in the world are completely dead, but back in the day, no one thought GE was going to get taken over. No one thought IBM or Dell was going to get taken over, or Qualcomm in the semiconductor space. And that's exactly what happened if you give it enough time.
Yep.
Right?
Yep.
So,
yeah, that's a great one. I like that.
Earnings season, Nicholas.
Yes. Yeah. So a bit of a tough end to the earnings season. I've talked about it on a couple of podcasts here, but this is a research note from 6/6 from Compound Advisors. And Jenna will throw these charts up. The comment is this: with the first quarter earnings season nearly complete, 97% of companies reported. S&P 500 earnings are down 14% versus Q4 of 21 and up less than 1% year over year. The first comment I'm going to make on that is down 14% versus Q4 of 2021. Q4 of 2021 was a really strong year because of they call it strong comps because you're comparing one quarter to another quarter from a year ago. But you got to think about everything that was happening post-pandemic. So those corporate earnings tended to spike, which is kind of why that looks so bad. So this chart, I'd put a little less salt in for listeners. I wouldn't freak out about this chart so much because the year-over-year comps are difficult. But it kind of ties into the next chart that Charlie talked about, which is with the operating profit margins. Now, this one I think is more important, and this is the one that's really driving some of the market action. And the comment is this: the big concern is that this trend will continue, with profit margins coming under pressure as companies find it more difficult to pass on higher costs to consumers. On that front, after hitting a record high in Q2 of 2021 at 13.5%, S&P profit margins have moved down to 12%. So 13.5% down to 12%. Common sense would tell us that's not that huge of a move, right? It's a small percentage move, but what's been happening over in this pullback that we've seen in the market is that cyclical rotation that you just talked about, where once profit margins start to turn over, that's signaling to us that, hey, we're moving into a different environment. The economic environment looks different, and that's why the market has really this is one of the key points that the market's been focused on, and hence why we've seen some of this sector rotation. So I think that's a good chart for listeners.
What and I thought it's just interesting that from the first chart, the comment was S&P 500 earnings are down 14% versus Q4 of 2021. And it's interesting because the S&P 500 is down 14% so far year to date. So again, you talked about what the nuances and differences of that is, but I just do want to make the point that I think these two charts do prove that earnings growth is what drives stock prices, right?
Yeah, this is all coming together pretty nicely.
It is. It's like an economics 101 class.
Yeah, with what Ben Carlson was saying in the article that you read. So, yeah, that's exactly a perfect way to summarize it. The next one I have is an update on the consumer. It's consumer credit is still increasing, and there's a lot of tweets and research on this, so I just grabbed one. But this is coming from a tweet yesterday from Liz Ann Saunders. She's the chief investment strategist at Charles Schwab. And the tweet says, borrowed time. U.S. consumer credit surged by $38 billion in April versus $35 billion estimate, and $47 billion in March, revised down from $52 billion. Revolving credit is up $17.8 billion. Non-revolving credit plus 20 billion. And there's a chart there that Jenna will throw up as well, and you can really see consumer credit spike. And what I'll point out is you saw consumer credit drop aggressively in the pandemic, and it's kind of spiked back up. And
this is even in the face of higher interest rates. So this goes back to our point that, Americans are consumers and our economy is consumption driven. And even with higher interest rates, higher capital costs, people are still spending. It's just what we do. And that's why I'm so optimistic going forward, is that people are still going to spend money over the next decade. And that's what's going to drive and continue to drive the growth of our economy. So again, if you're a long-term investor, I have no worries in the world, right? This stuff is going to get better because Americans are going to continue to spend, no matter how, to a certain extent, no matter how expensive things get. People will pull back, but they're not going to stop.
And they'll pull back, and then demand pulls back, and then the prices come down, and then we buy again. It's just classic.
We just go through the cycle over and over and over again.
Yeah.
Right.
Yeah. Absolutely.
So yeah, Lizanne has some good stuff.
Yeah. So that there's you'll probably see some things in the media over, if you haven't already, over the next couple of days of credit getting out of control. And I don't know if it's out of control.
Right. And when you're talking about consumer credit, I think it's an injustice to talk about it by itself and not relative to household income.
Exactly.
Because that's how you can compare across different periods of time.
Yeah.
So while credit may be a lot higher than it was 2 decades ago, so are household incomes, and you have to put it in that space together.
And wages have come up too, right? So, and the other thing is thinking about what's going on in the housing market and how people are having to say, okay, instead of paying X percent for my mortgage, I'm gonna have to bump that up because we need to buy a house because we've, whatever's going on, and the housing prices are going up, so your credit's going up.
Right.
You're borrowing more money because of the housing market. So that's also kind of unnecessarily elevating that chart, in my opinion.
Yeah, that's why I just want to caution people. When people see charts just about like credit alone and they're not comparing it along with household income and wages, then be a little sketchy.
Yeah, exactly. Yeah, ask a couple questions, particularly with data like that, because it's all about, there's so many variables underneath that. So the last thing I have is thoughts from Wells Fargo on the rate hike path. And this is a tweet from yesterday as well from Jonathan Farrow of Bloomberg. Everyone knows I love Jonathan Farrow. He's one of my favorites. Shout out to a
20-minute rant.
Shout out to Jonathan if he ever hears this. Big fan right here. Jonathan said this: we expect, he's quoting Wells Fargo in his tweet. We expect the Fed to raise the federal funds rate by 50 bips at each the June, July, and September FOMC meetings. We then expect 5 more 25 bips rate hikes over the course of the next 2 years, with the Fed funds rate rising to 3.5 to 3.75 in Q2 of 2023. And that's Wells Fargo. That's a quote from a research piece from Wells Fargo. That's a slightly bullish take, a slightly aggressive stance from Wells Fargo there. I took a look at the CME futures expectations on the Fed funds rate yesterday after I read this. And I looked at that for June of 2023. And what that does is it basically breaks out and it says it shows you where the market is expecting rates to be on a percentage basis. So, 20%, 26% of the market expects rates to be at 3.00 to 3.25. 33% of the market expects rates to be at 3.25 to 3.5. 21% expects the market expects rates to be at 3.5 to 3.75, and then there's smaller percentages off to the side to make up your 100%. But the current target rate is 0.75 to 1, and these rates, and what Wells Fargo is saying is that we as the market expect rates to be in that, call it 3.5 range, 3 to 3.5 range in the summer of next year, up from about 1% now. So
Right.
that's kind of where the expectations are.
Yeah, and I think that some of it, to a certain extent, I think the Fed can see the writing on the wall in that eventually, in the not so distant future, they're going to have to cut rates again. So they want to get it to a level where they have room to do that.
Exactly.
And I think we're just, again, in this never ending cycle of raising rates and cutting rates and raising rates and cutting rates. And I think it's important to note that, 3.5% sounds expensive relative to what we've experienced over the past decade, but if you look at it over history, it's
Relative
still
to free.
It's pretty close to being free, right? So again, these are all just expectations and forecasts and predictions. But I don't think it's going to be too long before, we get up to a certain level and they're like, okay, we're going to cut rates again to stimulate the economy.
I want to emphasize something you said for listeners, because it's really important, and I don't want listeners to miss it because it was just in one of the things you said. But like you said, the Fed wants to get to that level so they have room to cut rates in the event that we have a quote unquote hard landing and the recession is tougher, because at 1% there's not a lot they can do.
Money's almost pretty much
It's already
free.
pretty free. So that's why the path there's twofold, right? They want room to be able to help in the event that the recession is harder than it could be. And at the same time, that will combat inflation. But that's a very good point that you made. They need room. They want room, which is kind of why the market thinks they're gonna raise rates so aggressively so quickly.
Right.
That's a big factor in it that I don't think a lot of people talk about.
No, yeah, I appreciate it. It's definitely something that we need to consider, and I'm sure we'll be talking about this, 6 months from now, and I'm sure the market expectations for rates are going to be different from where they are today. So
very much so.
all right. Well, thanks, Nick. I'm going to pull in Taylor for our financial planning topic of the week. So I will see you probably sometime within the next few weeks back on here, sir.
Yes, thank you, sir, and thanks, listeners.
Just pounding away at that keyboard over there. Hey, Taylor, welcome back to the podcast this week. So what do you have for listeners for the financial planning topic of the week?
So today I'm going to be talking about PMI and how you could potentially get that knocked off with the current housing environment.
I was going to say right up front, I'm really not a fan of PMI. I think it's a scam. It's a waste of money, but
Well,
please
this will be an interesting
go
topic
ahead.
then. So first, I just want to cover some of the basics of PMI just to make sure listeners have a clear understanding. So PMI, it's a type of mortgage insurance that buyers are required to pay for a conventional loan when they make a down payment that's less than 20% of the home's purchase price. Lenders may offer low down payment programs, allowing you to put down as little as 3%, and the cost of that flexibility is PMI. And this protects the lender's investment, not really yours, in case you fail to repay the mortgage. So according to Freddie Mac, a government-sponsored enterprise, they buy and sell mortgages in the secondary market. They estimate that you pay anywhere between $40 and $80 per month for every $100,000 borrowed. So if you purchase a home that's worth around $300,000, the PMI monthly payments could be anywhere between $140 to $240 a month.
Okay.
Do you think that's a pretty accurate analysis?
I think it is. Yeah, I think it is. Again, and PMI relative to your purchase prices, it's not a lot from a monthly expense, but it's just like from my standpoint, I'm like, okay, I'm paying for the lender's insurance. So I'm not even paying for insurance on myself, right? So again, I don't really like it that much. And, my dad, I think I talked about this on the podcast before, is my dad, when it comes to finance, he has like two main sticking points. Number one is you should always, always, always buy a car. Should never lease it because it doesn't make sense to him financially. And number two is you should always put 20% down so you don't have to pay PMI. So I get that from my dad, but yeah, it's just one of those unnecessary expenses that I think they throw in there, and it's not really something that you ever need.
Yeah, I mean, it's probably geared more towards the younger buyers because they may not have 20% to put down on a home.
Right, exactly.
So the two most common options to pay for PMI is a one-time upfront premium that's paid at closing, or you can do the monthly premiums.
Yeah, and the more common is monthly to spread
Right.
that out.
Yeah, and the disadvantage of making the upfront payment at closing is that if you move or refinance your mortgage, you're not going to get that money back.
Right.
So PMI can be eliminated in a few different ways, but I just wanted to focus on what's called borrower-initiated cancellation. Basically, you can request PMI cancellation once the amount of your loan falls below 80% of the home's original appraised value. And I thought this was really interesting to bring up since, the value of homes have really spiked over the past couple years.
Mm-hmm.
So lots of people could probably get that PMI knocked off.
Yeah, and this is the interesting part, and I'm sure you're going to get into this, but so that's when you hit 20% equity in your home, you have to call and initiate them to take that off.
Correct.
Or else they just keep charging you for it.
Yeah, they're not going to reach out to you.
Yeah, and the only reason why I know this is because the last house that I closed on, the closing company gave me the date that I'm expected to hit that equity level, and that I have to call and tell them, hey, I have 20% equity in my home. Let's take this off, or else they're just going to keep charging you, which is, in my opinion, ridiculous. So
I agree.
Continue.
So like I said, I think it's important to bring this up because home sales have been increasing over the past couple years and the values have been increasing substantially. So, I mean, if you didn't expect PMI to get knocked off for another 10 years or so, you could potentially get that knocked off now.
Right.
And if you've done any remodels, that also adds to the value and can potentially get that taken off earlier.
Absolutely.
So, I mean, has this been a common topic of conversation at all?
It has, because the big question, I think, Taylor, is everyone is like, how much should I put down on my home? And like anything else in finance, I think it's a different conversation and a different answer for everybody. And it depends on the type of market environment that we're in. So, for the past several years, you didn't have to put down that much on a home to get a really good interest rate. But now when we're in a rising rate cycle, sometimes it makes sense to put down more so that you get a lower interest rate, right?
Right.
And you eliminate the PMI. But because we were in such a low interest rate environment, it made sense to put the least amount down possible and invest the rest of the money that you had from the sale of a home or the savings that you had to buy a new home because the market environment was great. And again, kind of how Nick and I were talking about how we're kind of going and entering into this different environment than we've been in for the past 5 to 10 years. It comes into play with financial planning because now people have to make the decision of, should I pay off my debt quicker if the interest is higher, or should I invest it? And obviously people are scared to invest it right now, just given the market environment that we're in. So if interest rates go higher, I think the break-even point of where it makes sense to pay off debt rather than investing is anywhere between that 7 to 9% range, just because historically that's what the S&P 500's average annual return has been since the market's inception. So I think it's just going to bring into question a lot more with people, with investors and with clients. It's what should I be doing, investing or paying off debt? And you got to take everything into your personal financial situation into account before just making a decision because you heard someone on the news or you read an article that said you should pay off debt or you should be investing that money.
Right.
So.
No, I completely agree. And I mean, by knocking it off now, it could save you thousands of dollars, especially if you had a longer term PMI.
Yeah. And it all depends on how long you're going to stay in the home.
That's true too.
Right. So if you're not going to stay in the home that long, why, tie up your money just to get to the 20% to knock $40 to $50 off of your monthly payment? If you're only going to be there for a couple of years, it might not make that much sense.
Yeah. So this would definitely be more for the longer term homeowners.
Absolutely. Yeah. If you found your home and you're like, this is the home I'm going to raise my family in, we're going to be here for 20 or 30 years, then yeah, I agree that makes sense. But the tricky thing is some people don't know that, right? There's a lot of people that make up their mind and they're going to be here for a certain amount of time. But if you're someone that lives in Dayton, for example, and you work out at Wright-Patt Air Force Base, you could get relocated at any time, right? So it's hard for people because they're like, I really don't know how long I'm going to be here. And if you're in that situation, I would recommend putting down the least amount possible and just paying that PMI as you go, because like you said, if you're not in the house long enough, then you're going to lose that money if you pay it up front.
Yeah,
So.
absolutely.
Oop.
So yeah, that's really why I just wanted to bring this up today. It's because, like I said, given the current housing environment, I think it's very useful for clients or listeners to know they could get that knocked off if they weren't aware of how this worked.
Right, exactly. And again, I just learned this just because I closed recently back in the fall of 2021. And so the automatic PMI termination kicks in when the mortgage balance is 78% of your loan to value ratio. So they get you for an extra 2% of that equity if you don't call and say, hey, I want to get rid of PMI.
Yeah, there's like I said, there's a couple different ways to do PMI, but I thought this was just the most general one to talk about, maybe the most common, but I think they're all pretty similar, sounds like.
Yeah. Yep. Well, thanks for bringing this up, Taylor. I know this is a pretty hot topic right now, especially with the way the housing market has been. So if anyone has any additional questions, please feel free to contact our office and Taylor can talk to you more about this. And I think we'll leave it there for the week for episode number 153. We'll be back with you shortly on Monday, just due to schedules and business commitments next week for episode number 154. So Matt and I will talk to you all then.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.